So we're going to start with we're doing our multi-method investing financial markets update. And I'll start as usual with just a review of what has happened year to date in various areas of the financial markets. So Nick, if you could just pan over this way. So indexes year to date in 2025. So it's talking about January 1st, and this data is up through the close of business on Monday. So it's changed a little bit since then. It's gone up slightly in terms of the stock market performance, but not a great deal. So as of the close of business Monday, world stocks, which is the broadest measure of stocks that we're including here, which includes not just US stocks, but also international developed and emerging market stocks, also includes across all of those large, mid, and small cap stocks. So it's a very broad measure of stocks around the world. That index, and here we're using the FTSE Global All Cap index, is up 6.82% for the year. Next on the list we have US large cap stocks. So here we're talking about the S&P 500, up 3.11%. And again, it's gone up slightly over the last 2 days also. US mid-cap stocks down 1.55%. US small cap stocks are the worst performer across all the broad asset types this year so far, down 6.06%. But this is much better than it was earlier in the year, or just a few weeks ago actually. International developed market stocks are the best performing asset type so far this year. They're up 15.49%. And we can talk in a few minutes or later about why there's such a difference in performance between international versus US stocks this year. A lot of that having to do with the dollar. Emerging market stocks, which excludes the U.S. and the international developed markets like Western Europe, Japan, Australia, New Zealand, Canada, South Korea. It's basically everybody else who has a functional exchange are up. But so emerging markets are up 11.31%. Again, a lot of that having to do with the dollar, weakness in the dollar, that is. U.S. short-term bonds. So here we're including treasuries, corporates, and agencies, and short-term being defined as maximum maturity of 5 years. Right? They are up 3.19% on a price basis. So this has nothing to do with the yield on the bonds. It's just a price change over that time period. And then U.S. aggregate bonds, which includes not just short-term, but also intermediate and long-term bonds going up to 20, 30 years even. Again, across that broad swath of corporates, treasuries, agencies, etc. Also up exactly the same number, 3.19%. So this is basically the yield curve is relatively flat, basically, as over this particular time period anyway. Tips: Treasury inflation protected securities are up more than the other types of bonds. They're up 4.02%. Okay, so all in all, you see here. I mean, there's a lot of green on the screen, so to speak, for the year. In this case, blue on the screen, really. But there are still some laggards in the U.S. stock area, and we'll talk about that in a few minutes. What's going on there exactly? Okay, so that's just for this year to date. So now let's take a step back and talk about what's going on historically over the last year to 2 years plus, and then also talk about what more recent developments mean for investment management and what clients and investors should be doing. So, all right, we'll go all the way back to January 4th of 2022, right, which you see over here on the graph. That was the peak of the last bull market. At that point, we went into a bear market that lasted until October 13th of 2022. That was the trough. Bear market being defined as a decline from a cumulative price decline of 20% or greater from a record high. Right? In this case, it was significantly greater than 20%, but off the top of my head. I don't remember what the number was, but it was, you know, in the 30 plus range as I recall. I could be wrong about that. I'll go back and look at that number. But October 13th of 2022 is when we troughed. And at that point, we went back into positive territory in terms of growth. Again, we're using the S&P 500 index here as our measure, just for simplicity's sake. And during this time period, it wasn't until January 19th of 2024, right? So, you know, more than a year, you know, almost a year and a half later, that we knew we had been in a bull market since October 13th of 2022. This is because with any type of market environment, you never know what you are in necessarily at the time it has happened. You only know in arrears what you have been in, right? In order to know that you're in a bull market, and this will come up in a few minutes, is extremely pertinent right now, actually today especially, which we'll talk about. In order to know you're in a bull market, you have to re-achieve the prior record price that was pre-bear market, right? So that last happened on January 19th of 2024. So that's the bull market indication. What happened right before then, though, is we had an intervening period of something we call a wolf market. So a wolf market is a period we identify as basically heightened volatility with no real clear bull or bear trend. You know, qualitatively, that's how you can think of it. But quantitatively, we define it as a period of a 10% decline or greater, but not 20%. So between 10 and 20% essentially, plus the recovery from the trough back to the prior record price pre-decline, right? So that happened. That we had one of those just over 10%. It was closer to 11% or so in terms of the max drawdown from July 27th of 2023 to December 8th of 2023. Okay, that's pertinent. That's pertinent because, you know, typically when you have the trough of either a bear market or a wolf market, on average, historically, the time until the beginning of another bear market or wolf market is the average is exactly 1.14 years, actually. You know, going back to, if you look at all the wolf markets in history and bear markets in history, going back to 1950, which is as far back as the data goes in this particular case with the S&P 500. That's pertinent because at this point, because we had this wolf market, we knew this, and it was confirmed, there was a trough here, we had begun preparing for the next wolf market, right? Because another thing that happens, historically, we know that there's an average of 2 to 3 wolf markets, but up to 5 or 6 that happen during any broader bull market time period, historically, right? So far we had only had one. So the expectation was that, okay, if you're looking at historical averages, we're most likely gonna hit, you know, around here, you know, 1.14 years out, we're probably going to start, you know, coming into the time where we get another wolf market, right? It turns out that we got something very similar to a wolf market, but just slightly bigger, right? Which started on February 19th of 2025, right? However, other things happened before that, right? So we actually went into, starting on December 8th of 2023, we went into something we call an eagle market, which ended on December 23rd of 2024. And an eagle market is an environment of rapidly, you know, qualitatively it's an environment of rapidly rising or soaring asset prices, hence the name eagle, with low volatility. And quantitatively, we define that as a period of trailing one-year returns of 30% or greater, without any intervening 10% plus corrections, right? So that occurred from December 8th of 2023 until December 23rd of 2024, right? So just about a year, right? Okay. On February 19th of this year, of 2025, we hit a record peak, right? And that is still the record peak that we have been monitoring over the last several months. We know this is a record peak because during this time period, the following time period, again, the expectation at this point was for another wolf market, right? 10% or greater correction, followed by a recovery. So we hit a 10% decline on March 11th of 2025, right? And the market kept going down. The market kept going down and down and down, and especially after Liberation Day in early April, where these the tariffs were announced. That's when a more dramatic slide started to occur, and it was on April 7th of 2025. So basically, from April 1st to April 7th, there was a dramatic slide, right? And at that point, we actually, on an intraday basis, so looking at all the prices during the course of any given day, right, as opposed to just the closing price, we actually breached the 20% decline threshold that indicates a bear market, right? What's interesting is if you looked at it on a closing price basis only, it did not breach the 20% threshold, right? So this is kind of like, it depends which measure you're using to tell whether this is a correction or a bear market. So it's right at the threshold. So we got a 21.35% decline, and so far, that was when the bear was indicated, and it's also the exact same date of the turnaround, right, so far. So what has happened since then is we've had a very rapid recovery, right? Probably, this is one of the fastest, if we quickly re-achieve the February 19th, 2025 prior records, this will be one of the fastest bear markets and the fastest recoveries from a bear market in history. It'll be up there. The only one off the top of my head that I can think of is Black Monday in the 80s, in 87, I think it was, right? October 87. So that's the only one off the top of my head I can think of that had such a dramatic decline, which was even more dramatic than this, and such a dramatic recovery so quickly, right? So, however, we don't know that that's the case yet, right? In fact, we may find out today, we may find out during the course of this event right now, whether or not we have re-achieved the prior record. Because as of this morning, we were only, as of the close of business yesterday, I should say, we were only 90 basis points off of the prior record, so 0.90% below the prior record price. And we're now, as of I just checked a few minutes ago, we're substantially closer to the prior record. So it may be that we breach that record today, or maybe not. All right, so that brings me to the next, the next part of this, which is what does all this mean? What does all this mean? What has happened here? This is just what has happened, but let's look back at history, look at averages, look at the range of potential outcomes that can occur in these scenarios. All right, so we'll start here with looking at bull markets from trough to peak. Right, so the fullness of all the bull markets in history. How do they measure up? Right. So if you look at that, the average duration in terms of time of a bull market is, and the range I should say, is 1.15 years on the low end, the shortest one, right, up to 9.55 years. So very wide range, right? But the average comes in at 4.29 years. So that the average bull market is 4.29 years, going back to 1950. And in terms of the returns during those time periods, you have a range of a positive 44.62% up to a max of 341.05% cumulative return from trough to peak. Right? The average coming in at a positive 133.09%. So that's a pretty nice gain in terms of average returns for bull markets, right? Now, another way to look at this is looking at, where did that put us in terms of the most recent bull market that was confirmed? Well, the length was 2.35 years, and the gains were 76.06%. So again, comparing that to the averages of 4.29 and 133.09, it was basically approximately half the length and half the returns of the average bull market. So this was on the short end and the small end in terms of bull markets in history, right? Bottom 50%, we'll call it, right? Okay, and that's confirmed as of right now. Now, looking at our more current situation, right? What can we determine based on this bear market that is now confirmed, right? So, looking at bear markets after they've been indicated until the trough. So, in this particular situation, to put it in context, we're talking about this exact date, like April 7th of 2025, right? That's from that date until the trough, right? In this example is what. So historically, the time until the trough lasts anywhere from 0 days, okay? Take note of that, right? Up to 1.63 years from here, so in that case, you would have a further decline of an additional 1.63 years from here. With the average being 4.61 months, right? Now, before I get to that, the average additional cumulative decline from this point to the bottom is another 16.56% on average, right? That's the average additional loss after that first 20%. Okay. What's interesting though is if you look at the data at a more granular level on bear markets, there's kind of like two types of bear markets, right? I kind of think of them, I've never written this or done any hard research on this other than just looking at the data and seeing this. You could think of it as two different types. I kind of think of it as like a bear cub and like a big boar bear market, right? So because the reason for that is that approximately 50% of bear markets in history, they turn around within 1 month after indication, right? So the other 50%, it usually takes much longer and they get much deeper. So there's this kind of polarization within bear markets. Also, like I said, the bottom range of these in history, there's been a couple of these that have turned around on the same day, right? So far, look at our exact situation here, right, so far, right? So far, the bear market was indicated on April 7th, and it has so far, if indeed we do re-achieve the prior record price before we retest these lows, this also will have been a situation where we turn around on the exact same day that it was indicated. So this will bring down the averages, basically, if that's what this is. So that's interesting to note, given that as of this morning, we were only 90 basis points off the prior record, and right now, as in real time, we're even closer to the prior record. So we'll see what happens, right? Because there's basically 3 potential outcomes, which I'll get to in a minute. Just before we get to that, another thing that we look at in terms of how we analyze markets. This is the historical market type data analysis is what we call this. Another way we look at markets is by quantitative probabilistic analysis. And what that means is we basically look at a series of asset types and we measure probability distribution curves, like bell curves, right, on these. And the bell curves will tell us the direction and degree to which something is over or undervalued relative to its historical averages, right? And so we can look at that like asset by asset, and we can also compare asset types to determine which of the asset types that are out there are more over or undervalued than others, right? So you can look at like an absolute basis and a relative basis. So if we do that, probabilistically, stocks right now, as of this morning actually, ranged from near fair value, right? So very close to their historical averages, so not too cheap, not too expensive, to slightly overvalued. And I can talk about which ones are in those particular ranges in a moment. And then bonds, almost pretty much all bond types are near fair value at the moment. Okay. So in summary, right, we have a confirmed bear market, right? And we also know that historically, based on all the data, all bear markets are followed by bull markets, right? If you go by the traditional definition, right? They just alternate that throughout history. You have a bear market and you have a bull market. You have a bear market, you have a bull market. It's simple, right? It's simple in concept. The problem is you never know when either of those are going to come, right? When one is going to start, or whether you're even in it until it's over, right? That was the point I made earlier about knowing things in arrears. So we have a confirmed bear market. We know all bear markets are followed by bull markets, and we know at this point we have three potential scenarios that we could be in. One would be we have an extremely rapid recovery, one of the most rapid recoveries from a bear market in history, right? We're getting extremely close to that being the case. Another potentiality, which has happened before, is you get really close to this, and then you get a drop, and then you retest the lows and go past the former lows, right? And you deepen the bear market. That right now looks, because we are so close and to this prior record, it looks like that's probably a lower probability situation, but historically, it actually is a higher probability situation. You know, if you look at the averages, historical averages. So it's really hard to tell what's going on right now. The only thing that makes me think that it is the earlier one where we are going to, in the near term, re-achieve the prior records is the fact that there are these two different, versions of a bear market, of a bear market, right? The ones that are very short-lived and shallow, and the ones that are much longer lived and deeper. And it seems that so far that we are probably in the former, right? So that's potentially very positive, right? Okay. The other potentiality, which has happened, and we talked about this in the prior session a little over a month ago, and we did another session with the FPA, the Financial Planning Association, where I did a similar conversation on this, where we're going to get some drifting around for a while, right? And that has actually happened more recently. So we had basically this really rapid recovery, and then we've been kind of drifting around in this relatively range-bound trade here for a while, but now it's more of a drift up as opposed to a drift sideways, right? More recently. So those are the three potentialities. So what does it mean? Right, we're kind of at this threshold now where it could go two different ways. So what do, right? So come over. If we can come over here, Mick, I don't know if you can zoom in over here. The outcome of our analysis is that, and I'll talk first about the outcome of the analysis based on the fact that we have not yet achieved this prior record, and then I'll talk about what happens if we do achieve the prior record in the short term, right? So what does this mean? And this really applies in either scenario, whether we hit the prior record or not. It means that the stock outlook in the short term is still a question mark, as you see here, right? We don't know what's going to happen. It's going to any of these three scenarios, right? Could be occurring. But we know in either of those scenarios, the intermediate to long-term outlook is positive, right? So what does that mean? It means be offensive, be aggressive right now, generally speaking, right? Obviously anything that I talk about in terms of that seems like a recommendation, it's not a recommendation to a specific client. This is general, observations, and you need to apply this to the specific client situation to determine if it's right for them. Just a caveat, right? Disclosure, so to speak. Other things to be aware of are what we are doing now, what we have been doing during this entire time period, especially since the bear market was indicated, is we've been recommending and implementing for our clients overweight allocations to strategic asset allocation and selective or concentrated investing, and underweights to liability-driven investing and opportunistic investing. And I'll just real briefly, Dan mentioned these before in the prior session, but I'll just real briefly go through those again. So basically, strategic asset allocation, is where you have a diversified portfolio of stocks, bonds, and other asset types. You set a percentage split between the various types and rebalance back to those splits over time, really only making adjustments to the portfolio based on changes in the investor's life circumstances and risk tolerance, and not necessarily in response to market changes. Then you have selective or concentrated, and that, by the way, that tends to do best in bull markets, right? Which is why we're allowing overweight right now, because we believe we're most likely in a bull market, right? Or entering one at least. Then you have selective or concentrated investing, which does best in eagle markets, right? Which is also in a positive return scenario, right? Eagle markets. So selective or concentrated investing is where you have you don't care about diversity, you don't care about risk transfer or tactical portfolio manipulation like the other three methods. You just want to know as much as you possibly can about the select portfolio of companies you're invested in and manage those positions accordingly, right? That type of arrangement does best in an eagle market, but also is a second best performer typically in a bull market scenario, right? Which is why we're allowing continued overweights there. Then we're underweighting liability-driven investing and opportunistic investing at this stage. All right, underweighting, so liability-driven investing is where it's used by big institutions like banks, insurance companies, big public pensions. It's about transferring risk from one party to another. It's about quantifying your risks and liabilities, and then finding a perfectly, or as close as possible to perfect, offsetting asset to purchase to transfer the risk to another party, right? It's about insuring and using fixed income instruments and derivative instruments. That tends to do best in a bear market scenario, right? So we already know we were or are in a bear market scenario. The time to be overweight to that, right, was up to and during this time period. We have seemingly at least gone beyond that time period, which means that we can continue to allow underweights to that area. Similarly, for opportunistic investing tends to do best in a wolf market, right? And a wolf market is an environment like I described earlier, where we get, you know, the 10% plus decline, but not 20% plus the recovery. And opportunistic investing involves tactically manipulating the portfolio. Things like absolute return strategies, tactical asset allocation, hedge fund-like strategies. These have the capacity, or the, if not in practice, at least in concept, right, to be able to capitalize on that kind of environment when it occurs, whereas all of the other three methods of investing do not even have the capacity to do that. Right? So that's why they tend to outperform in wolf market environments. We were preparing for that during this entire time period for a wolf market, and just as luck would have it, we were also allowing overweights to liability-driven investing during this time period in a more flexible separate account strategies, which means we were absolutely perfectly positioned for this downturn during this time period. So that was the time to be overweighting in those areas. As this occurred, it was time to be gradually getting out of those and into the strategic asset allocation and selective concentrated investing under the expectation of a turnaround in the market, which we know eventually does happen always, historically, right? 100% of the time, you go from a downturn into an upturn, at least in US stock market history. It's just a matter of how long does it take, right? So, what else? So other things to consider right now, if we get a little bit more granular over here, where if we think about probabilistic analysis, you know, stocks and bond types, what's overvalued, what's undervalued. Like we said, most things are pretty close to fair value. There's nothing that's really extremely overvalued or undervalued at this point, but there are some areas that are a little cheaper or more expensive than others. Right? Long-term U.S. Treasuries and growth stocks in the US in particular, think about like tech stocks, they look the cheapest. They're not super cheap, they're close to fair value, but they're cheaper than other things, right? And then in terms of more expensive asset types out there, you have the international developed market stocks and the emerging market stocks. So basically anything outside the US in the stock market, in the stock arena, looks more expensive than other asset types. You know, you can kind of see that just by what's happened this year over here so far, with the outperformance of the international markets versus the domestic markets. Okay, so what does all this mean? Again, under the assumption that we are where we are, right, and we have not, breached the prior records. I think this advice would still apply either way, or these concepts would apply either way. But for income investors right now, so people that are taking withdrawals from their portfolio, they're in retirement, right? There's less that they can do at this stage other than to minimize the systematic withdrawals that they take out of their portfolio, right? And try to live off of any excess cash they may have accumulated in their liquidity fund to supplement what would otherwise be coming out of their portfolio temporarily, right? And why? Because that keeps more money at work in the marketplace right now while the market is still down and recovering from this bear market, right? So that is a good thing to do. Another thing to do for growth investors there's actually a couple of approaches for growth investors. There's more options there. One of the things you can do is the opposite, right? Is to increase your systematic investments into your portfolio of earned income. Right? So I'm not talking about dollar cost averaging in any lump sums of cash you might have on the side. I'm talking about, to the extent you can, max out your 401k contribution right now. Max out the amount that you're putting in systematically into your taxable accounts, right? Or 529 college plan savings accounts, right? Because you want to take advantage of this. Now, it's not much of a discount now, but it's only 1% off of prior records. But going back to what I was saying before, bulls after indication to peak, and actually that's what I'm going to get to next, right? I didn't really talk about that, but basically what happens is after you get the indication of a new bull market, if you achieve prior records, typically you're going way beyond those for an extended period of time before you get another correction or bear market. So no matter how you look at it, it looks like a good time to be aggressive and offensive, right? And so another thing that growth investors can do is they can deploy cash lump sums now en masse, right? So there's no need for very much dollar cost averaging at this point. If they have a big chunk of money on the side that they don't need for their short-term liquidity, and safety portfolio, or for expected upcoming expenses. This is a good time. It's still a good time. It was better, 2 months ago. That was a great time to dump money in lump sums, but it's still a good time to deploy cash that is idle on the sidelines. And right now, because we are so close to this prior record, and it's very likely that, and we're also, several months after, we're 2.5 months or more after the bear indication. At this point, to give context, at this point, our recommendation to clients was, you want to drop in approximately 60% now, immediately, right, on indication here, and the remaining components of the portfolio of your cash should go in, over the next 4 months at 10% each, right? That's roughly what our algorithms would tell us to do with client cash at that point, and that's based on the historical averages, saying that the average after an indication, the average time at the bottom is about 4.61 months. So basically, you put in a large chunk immediately once the bear is indicated to take advantage of the 20% decline, and then you drip in the rest of it over that time period to try to take advantage of potential further declines. In this case, we have not had further declines so far, right? So the time now is to, because of the elapsed time since indication, the historical average would tell us, if you're just going by the average, right, and not thinking about the two different types of bear markets, right, that would tell us that you'd want to drop in 87.5% of your cash immediately now, and then 1 month later, let's say in late July, August, you drop in the remaining 12.5% of whatever cash you have available. Now, because we are so close to this prior record, from a practical standpoint, as long as you have an intermediate to long-term time horizon here, it may be more practical just drop in 100% of that immediately, right now, and not mess around with this, the extra 12.5%, just because of the fact that we're so close to the prior record already, right? So that's something to consider. Okay, so I think those recommendations still apply no matter what, whether we breach this record that, in a short term or not. Now, but let's talk about what would happen if we do, in the short term, breach this record, or whenever we ultimately do breach that record. What do things look like going forward, right, from that, based on history? So if you look at bull markets after indication until the peak of that bull market, right? If you look at the history of that time period. So in this context, that would be from this prior record until the peak before another downturn, another bear market occurs, right? How long does that take? Well, historically, on the absolute shortest one in history was an additional 6 days, and this was back in the 2007, 2008. It was related to that market where it was if any of you recall, that was referred to as the lost decade, right? That's the only time in history that has happened, where we re-achieved a prior record and then went back into a bear market very quickly. The longest time period in history before the next peak was 7.44 years, which was also related to 2007, 2008, which is the time period following that bear market back to the prior record, right? So both of those extremes are related to the financial crisis, right? Everything else has been somewhere in between that, and the average time from indication to peak is 2.44 years. So what does that mean on average historically? If we re-achieve this prior record today, I don't know if that's, or it may have already happened, somebody can look at their phone and tell me, but if that occurs, on average, you got about another 2.44 years of growth in your portfolio before you need to think about, a potential bear market, right? And in terms of potential gains, the range and the averages there, the shortest or the worst gain after indication was 2.09%, with the best being 225.74%, right? So again, a very wide range, the average being 52.53%. So if you just look at the averages here, if we re-achieve this prior record, on average, you're going to get about another 2.44 years of growth and an average of about 52.53% of cumulative gains during that time period. So no matter how you look at this, even if we went back into a substantial slide and retested these lows right now, right, that would be an even better time to deploy cash, right? It doesn't seem like that's going to happen right now. So the time to deploy cash, all things considered, is don't wait, is to get it in the market now. It's still a time, no matter how you look at this, it's a time to be offensive and be aggressive, right? And that's what we're doing that's what we're recommending to our clients, right? For those people whom it's appropriate. And that's what we're doing with our clients' money that we have discretion over, that have a flexible mandate in their portfolio. So that is essentially where we stand right now. I'm very interested to see, at this, what happens. We're at this critical juncture right now. It'll be interesting over the next couple days. So we'll see.